Hello everybody. Welcome to our video on 3 ways to manage your options position. This is an extremely important topic. Now the reason this is so important because it just creates different escape paths. If you own a stock, to get out of the stock, you could sell the stock. But if you really want to increase your odds with the stock, you could own the stock and maybe you could sell some options against it. Maybe you can do a pair against that trade. The more different ways that you can manage the position, it's just going to increase your odds for success. And in options, there's a lot of different ways we can manage those positions once we have the risk on. But like anything, especially when there's money involved, we have to be comfortable in order to execute on those strategies. So that's what we're going to go over today. So 3 different ways to manage your options positions. In front of you, we're just talking about fit. We're only going to be looking at the calls for this example, and then we'll look at the puts later. We're going to concentrate on the March expiration. There's 44 days until expiration. And we're going to go over 3 different ways that we can manage our options positions. The first, if you're long an option, you could just cover. Just get out. Long an option, we'll cover. 2, we can roll it into a spread. And then 3, we could trade stock. 3 is also called scalping gamma. And by doing any one of these 3, when you have an options position, you're just increasing your odds for success. If you're long an option and the only thing that you've been doing is covering your option in order to take profits, well, you're at a disadvantage because just because you can cover the option, that doesn't mean that that's the best course of action to take. And so that's why we're going to do this video, just to increase your odds once you're in an overall trade. So let's erase this. So Fitbit. Let's go over each of the columns. Last trade, 1609. We have volume, open interest, delta, extrinsic, intrinsic, theta, vega, and bid ask. We don't have the puts on here just to keep things simple. Now the first thing I always do whenever I look at an options position, whenever I look at an options tree, 1609 fit, last trade, is I always want to look at the straddle. So if the last trade is 1609, we have to look at the at-the-money options, which would be the 16 strike. And then we just do calls on the 16 strike, which are going to be, let's call it 230. And then puts. So 230 is going to be the 16 calls. Just put C here. And then the puts are at a frame, but let's call them 230 as well. And those are going to be your 16 puts. And now the straddle is we just add those 2 together. Now what that means, or what that's telling us, stock's at 1609. If we add 460, it's going to be 2069. And if we take away 460, that's going to be 1149. Is that math good? 1649 less 40. That looks good. So this is the first thing I always do. Last trade 1609. So the straddle, what that's telling us is if we sell the straddle, sell the call, and sell the put, we just want the stock to quiet down and stay between this area. Whenever you're selling volatility. You're selling the VIX. You want things to calm down. You do not want movement. You just want to be able to sell the straddle for 460, and if it doesn't move, everything expires worthless, and you get to keep on a 10 lot $4,600. Great trade. But the buyer of the straddle needs movement, wants movement. So you want to be under 1149 by expiration or over 2069. The buyer of the straddle. The buyer of the straddle wants volatility. The buyer of the straddle needs craziness in order to profit. So right away, though, this is telling me that in 44 days, the market is definitely pricing in some movement for fit. And I look at the straddle as kind of a 50-50 play. 50% under, 50% over. It's probably valued pretty close to whatever overall value is. So that's why I always look at the straddle in order to see what kind of movement that we can expect, which is obviously very good for money management. So that's the number one step. So we'll keep this up here. Straddle is going to be 460. Stock at 1609. Now let's go over the options tree, so we're all looking at the same thing. You have volume and open interest, which is extensively covered in the Unusual Options workshop. Delta. Delta, think about delta as the percentage chance that your options are going to end up in the money. So delta, I use this for delta. So if the delta is 1, the market is saying there's a 100% chance that option is going to end up in the money. So the delta being 95 strikes at 8. The calls at 8 when the stock's at 16, it's just like buying stock, pretty much. The market is saying there's a 95% chance this ends up in the money. So if the strike's at 8, if you're just buying stock and the last trade is 1609, then what you can do is on the 8 calls, if you buy them for 809, 8 plus 809 equals 1609. So it's just like buying stock, right? If the stock's at 1609. Now, if you could buy it less than 809, all day, that's called arbitrage. Because say you bought it for 8, now you're buying the stock for 16, and you could sell 1609s and lock in 9 cents. Now, this doesn't happen very often, but I think it helps to show the value of the 8s, what delta is. So this is saying this is just like buying stock. Versus with the stock at 1609, if we look at the 23s, the delta on these is 20. So this is saying there's only a 20% chance that this market can really get up here. So that's the way you can look at delta. It's a great little cheat sheet. Next, we look at extrinsic and intrinsic. Intrinsic is real. So 8s, intrinsic 842. It's going off this bid ask because the market just opened. 8 plus 842 is 1642. So this is how much real stock is in the position. The extrinsic, this 23 cents, fluff, not real. Not real at all. Extrinsic, if we look at the 23s, they have no intrinsic, and it's all extrinsic because 23s, there's no real stock in there. The stock's at 1642, 1645. So there's no intrinsic, there's just extrinsic. That's all the premium that's left. That's all the time, really, that's left in the trade. So that's going to be the difference between extrinsic and intrinsic. Theta is how much the option price is going to go down every day before expiration. Last trade, 230. If the market just shuts down today and opens up tomorrow, these options are going to be priced 2 cents less. Vega is often confused with volatility. Vega is not vol. Okay? What Vega is if volatility is at 30% and then everything calms down and it drops down to 29%, Vega is how much your option is going to move based on a 1% move in volatility. So with this 16 strike, the Vega's 2 cents. If vol goes down 1%, if things calm down and fit, 2 cents is going to be taken out of that option. So that's what Vega is. Don't confuse Vega with vol. And then, of course, just our bid ask, what the market participants or the market makers are willing to pay. Now we get into managing our options position. And for this, we're going to need to set the table. And what I'd like to do is still using fit. Let's say we're long the 18 calls in March. So long 18 calls. I'll put 44 for 44 days in March. So we're long the 18 calls. Right now they're at $1.40 at $1.60. Now let's say we bought 18 calls for $1. Yeah, we bought them a couple of days ago. We're in a good trade and we bought it 10 times. So we invested $1,000 in this position. So we're long the 18 calls. Stock's at 1609. We bought a 10 lot for $1. So that's going to be $1,000. So how I want you to think of this, and for me, I think this is the easiest way of thinking about it. If the stock's at 1609, we're long from 18. And we're long 1,000 shares. Okay? But also, since we paid $1 for these calls, we're really long from 19. So let's look at it from that perspective, that we're long from 19. And that includes what we spent on the option. Now we could say we're long from 18 and we're down $1,000, or we could just say we're long from 19 and include that. I think it's best to just think that you're long from 19, and that's going to be the easiest way, to understand the different options that we have available for us. So today, market's opening up. It's going to be a little bit strong. We're long the 18 calls from $1. This it's looking pretty good. Okay? So what can we do? Well, right now we see bid market is about $1.50. So if bid market's $1.50, we could just sell because we're long from $1. We could sell $1.50. And then we're flat. We made 50 cents. We made $500. Cool trade. Love it. Flat. No risk. No problems. No problem. Okay? So that's just super simple, right? We bought these 18 calls for $1. We sold them for $1.50. 50% return on our money. We're happy. We have no problem at all. Okay? So let's call that option 1. Now for me, that's going to be the worst of the options because I feel like I'm just getting out of my trade because I'm up money. I'm not getting out of the trade that, maybe something has changed or the bias for getting into that trade has changed. I just feel, hey, we're up some money. Let's lock it in. Let's move on. Because there's a lot of better things that we can do. So 1, go ahead. Sell your options. No big deal. We're flat. But we're not always trading names like Fit that have the kind of liquidity that Fit has. Fit has pretty good liquidity. These 20s, 90 cents at $1.05, you could always sell those 90 cents. For me, if I wanted to sell that, I would offer $1. I would never just pay 90 cents. I would just want to offer $1 to see what's in there. Maybe we get filled. If I have a 10 lot, maybe I'll offer 2 at 95 cents and offer the balance at $1 just to be able to get on some prints and get filled. Now the next option that we can do, 1, just selling at your calls. The next thing we can do is we can leg into a spread. So let's call spread option 2. Because right now we have $1,000 of risk on because we bought these for $1. But in doing a spread, we're long 18s, 19s, 20s. Let's offer the 20s for $1. Okay, so offer 20 strike for $1. Now, I think on the opening that we're going to get filled because the stock's up 20, 30 cents. So right away, the stock's up 20 or 30 cents. The delta of these is 33. We're going to actually get about 1/3 of this delta, so it's going to go higher by 11 cents because it would go up 33 cents on a $1 move, but since it's up only maybe 40 cents, we're going to get about an 11 cent, 15 cent pop. So spread, we're going to offer the 20 strike for $1, and then let's say we get filled. Now, 18s, we're long 10. 20 strike, we're short 10. We paid $1. For these, we received $1. So what we just did is we put the 18-20 call spread on for 0. Because we bought these for $1. 18s we bought for $1. The 20s we're going to sell for $1. So we cannot lose money. Bought $1, sold $1. Debit, credit, $0 of risk. And now our max upside, now we're in this 18-20 call spread for 0. The most that we can make is going to be the difference between the two strikes. So our profit potential is going to be $2 or 2,000, and our risk is going to be 0. Because now we have this call spread on. We bought for $1, sold for $1, we legged into the trade. We obviously can't just do this if we're just initiating the trade, because nobody is going to allow us to put on spreads for 0 and just have upside. But this is something that we can do in order to manage our trades. We're long those 18s from $1. We just sold the 20s for $1. The max that we can make is going to be 20 minus 18 or $2. 10 times is going to be 2,000. The way that we capture this is if the stock gets above 20. Above 20, we're going to make $2,000. Now, if the stock expires at 19, our 18s are going to be worth $1. Our 20s are going to expire worthless, so we get to keep that $1. And then we're just going to have to sell 1,000 shares because we're going to be long calls. We're going to be long 1,000 because of our $18 calls. We're going to be long 1,000 shares at expiration. And the 20s, these are going to expire worthless. So our position is going to be long 1,000 shares. We'll sell 1,000 shares at 19. These we're going to break even on because we paid $1 and now we're getting out for $1. But here we're going to get to keep the $1. So at 19, this position is going to be up $1,000. So this is a way that we can manage a trade but still stay in the trade. I'll go over one more example with a spread using a different strike. We're long these 18s. We're long 10. Let's sell the 23s. Let's sell 10 of the 23 calls right here. Let's say we sell for 50 cents. So these cost us $1. The 23s, we're just opening. Let's sell for 50 cents. Now our risk is going to be 50 cents because debit, it cost us $1,000. We're getting credit, $500 in our account by selling these 23s. So the most that we can lose now is $500. At first our risk was $1,000, but now we're managing the position. Now our risk is going to be $500. Still keeping ourselves in position to make money on the upside, but most importantly, we're taking our risk down. Our risk is $500. The most that we can make on this trade is just the difference between 23 and 18. Change colors here. So we're going to have the 18-23 call spread on for 50 cents 10 times. $1 less 50, so it's on for 50 cents. We have 500 of risk, and the most that we can make, 23 minus 18, is $5, or 5K minus the 500, so it's 4,500. So this is a way that we can manage our risk. We're still staying in the position to be able to capitalize on the upside, but this is a way that we can manage our options. This is a much better play than just getting out of those 18 calls. And the reason I like doing stuff like this is because 18s are a 25-cent wide market. Well, maybe these 20s are a nickel wide or a dime wide. So it's giving us more options. It's giving us more choices to make. So that's why rolling into a spread is always a good scenario. Sometimes, if we're long the 18s for $1, maybe the 20s we could sell for $1.20. Now our risk is not only 0, the most, our downside is that we make $200 because we'll get that spread on for a 20-cent credit, $1, and then the 20s for $1.20. $1 minus $1.20 is going to be plus 20 cents. So our worst case scenario will be we make $200. So this is another really good option to do. And the same thing on the puts. The puts will just be opposite. And so now let's get into the third way of managing your options position. This way is my favorite. It gives us the most flexibility. And the thing I like about it, it allows us to keep the optionality of our position. So if we just cover our options and fit in front of you 16, we're long the 18 calls. These are in February now. We could just cover our options and then we're done with it. But you can see the 18 options. The market is 55 cents at 65 cents. I don't really like to pay 55 cents to get out of my options, because when you're paying the offer to get in and you're paying the bid to get out, that's a lot of slippage. There's a lot of extra room in there that you don't have to be giving up. So by scalping Gamma, that's going to be our most efficient play. And I'm going to go through an example on the call side, and then we'll do an example on the put side. So fit 1611. Last trade. And let's, for an example, say we're long from the 14 calls. Let's say fit just went from 10. It's been rallying all the way up to 16. And we're long the 14 calls 10 times. In this example, let's say we paid 20 cents. Let's use 50 cents, just it'll be easier on the math. We paid 50 cents, so we risked $500. Okay? Fit was at 10. It rallied all the way up to 16, 11. We're long the 14 calls 10 times. Now, we've already shown two possibilities of things we can do with this position. But this one's going to be the most important and give you the most flexibility. So now, instead of thinking that you're long the 14 calls 10 times at a price of 50 cents, switch your thinking. Let's just say we're long 1,000 shares from 14. Okay? So if we start thinking like this, it costs us $500. You could also say you're long from 14.50, or we're long from 14 and we just risked $500. When fit gets up to 16, we can sell up to 1,000 shares. If we sell 1,000 shares at 16, we're going to lock in $2 minus the 50 cents that we paid. So we're going to lock in $1.50 on the trade. Because we spent 50 cents to get into the trade. We're long from 14.50. Now we sell stock. We're long 1,000 from 14. And now we're short 1,000 from 16. So this allowed us to cover our position. Now, why would we do this? Well, look at the market in the stock. The market in the stock is only 4 cents wide, sometimes 3 cents wide, sometimes 1 cent wide. So we're dealing with a much more efficient market than to go in the options, where oftentimes we're looking at a 10 cent, 15, 25 cent wide market. So this gives us easier fills. So let's keep this example here. I need to create some more room. But now watch. So fit went from 10 to 16, 11, 16, 11. Now we sold 1,000 shares at 16. So now we locked in $1.50. But let's say fit before expiration goes back down to 12. Now if we covered our options, we would be flat. It wouldn't matter. But right now our position, we're still long the 14 calls. We paid 50 cents. And now we're short 1,000 shares from 16. And that's our position. But if the stock drops to 12, now what we can do is let's buy 1,000 at 12. Now what's our position? Well, we're flat stock because we sold 1,000 and bought 1,000. So we locked in 4,000. And we never touched our calls. Because we never touched our calls, we still are long 10, 14 calls from 50 cents. So our net P&L is going to be up $3,500. The great thing about this approach, and this is scalping gamma, and we'll go through another example on the put side, but the great thing about this approach is you never give up your options. We still have the optionality if FIT drops to 12. Let's say instead of 16.11, FIT rallies up to 20. Well, we're long, this goes back to this example, so we're long 1,000 from 14, we're short 1,000 from 16, so we don't get to participate in any more of the upside. Maybe instead of selling 1,000, we could have sold 700, and then we could have participated on the upside for 300 shares. But what we did here, because we sold stock, we covered stock at $16 and took away the upside. But we still have downside exposure because we're short stock. And what this is synthetically, we now have a put. Because if you think about how it's priced, if it keeps going up, we don't get to participate in that. But if the stock sells off down to 12, we do get to participate. So the price behavior is exactly like a put. Now you may need to go over this example a few times. I'm going to do the same example on the put side just so we can get a better feeling for this. And now let's do an example on the put side. Now FIT, let's say it's trading at $16. Let's buy the 14 puts for 20 cents. And let's do that 10 times. So right away, let's start thinking that we're short 1,000 shares of FIT at $14 or even at $13.80 because it cost 20 cents to put on this position. So if FIT is at 16, at 14, we're short 1,000. So $14, we're short 1,000 shares if these become in the money. Now, if FIT doesn't get in the money, we're never short 1,000 shares. Then we just lose our premium. And this premium is extrinsic, and it's all fluff. It's not real. FIT's at 16 right now. We don't want to be short from 14 because it's at 16. So what happens, again, is if FIT drops down to 12, and if we want to lock in some profit, what we can do is we own 10 of the 14 puts. We can buy 500. Let's buy 500. We're going to buy 500 shares. Now, we're only going to be short 500 because this is covering 500. So what happens here is, for this example, we made $2 on the cover, less 20 cents. So we made $1.80, and we made that 5 times. So that would be $900 that we get locked in. Because we're buying 500 here, we're short 500 here, so we just made $2 on this trade, less the 20 cents that we paid to enter the position. Now we also have 5 other puts that we haven't touched at all. So why don't we say the new position 14s. We're still long 5 puts. And the other 5 were flat. Sure, you can say that we're long 10 puts and we're long shares, but otherwise you're pretty much flat. What happens though, if it rallies from 12 and it rallies back up to 18, we could always just sell these 500 back out. Sell those 500 shares. So this will be flat. This is flat. And we go back to our original position of 14 puts for 20 cents long. And so by doing this, we never are messing with our options. We're always keeping our options in the game because options have optionality. That's what we want. I hate selling any kind of options for under 20, 30 cents. There's just no reason to do that. It's just a lot more risk, and you're not really getting anything for it. If I sell an option for a dime, 10 times, it's $100. I'd rather keep the optionality of that position. So what this allows us to do, it allows us to stay in the game. It allows us to cover. It allows us to lock in profit, but not taking our upside potential off the table. That's why I like to do it. Sometimes I scale. If I'm long 10 puts, it's short 1,000. Maybe when it drops down 13, 12, 11, I'll buy 300, 400, and buy the balance. Lock in a great trade, and then you're getting long, hoping that it rallies. Scalping Gamma gives you opportunity. A lot of people aren't familiar with this kind of approach, but all you're doing, it's the same thing as just taking your puts or your calls, think of them as stock, and then using the stock to manage your position. I really encourage you, watch over these 2 examples. Do it on paper, do it nice and slow, and ask me any questions that you like. These are the questions that I get most from my members, and the members who are really embracing it have seen great benefit from adding this because all you're doing is increasing your odds. If you used to trade options and all you would do is cover those options, this changes nothing. This just opens up new avenues for you to increase your odds of getting a return. That's why I like it, and that's why it makes sense to me. So there you have it, guys. 3 different ways to cover your options position. Anybody risking money in options, you need to be familiar with these 3 different ways. Let's not just cover options one way. If you need to paper trade Scalping Gamma, do that. But really try to integrate this approach into your risk taking because it's only added benefit. There's no risk that's added by learning this approach and by utilizing it in the market. Hope that helps. If anybody any questions on this or about anything, I encourage you to reach out. Jonathan at Active Day Trader. Thanks, everybody. I hope it was beneficial, and we'll talk soon.